Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And today's guest is Brian Davis. He's a real estate investor, personal finance writer, and co-founder of Spark Rental with over 2 decades of experience in the industry. Brian loves showing others how they can create their ideal lives through real estate investing and lifestyle design. So without further ado, welcome to the show, Brian.
Gino, thank you so much for having me. So glad to be here.
How did you get into real estate? That's the question I want to start out with.
You know, I fell into it by accident, which is it's not a sexy answer, right? To expand on that a little bit, so I graduated college back in 2003. I had zero clue what I wanted to do with my life. In some ways, I still don't know what I want to do with my life. But so I was asking my parents, like, "Hey, can you just introduce me around to your friends so I can figure out what people actually do? What do adults do with their time all day?" Because you grow up and you know about 5 different jobs, right? You know, like firefighter and police officer and teacher, maybe accountant, but you don't know what the average person is doing with their actual, their day-to-day work at 11:18 on a Tuesday morning. So anyway, a friend of my stepdad's was a owner of a nationwide, it was a subprime mortgage company, which nowadays we look back and we're like, oh my, we kind of hold our noses. But at the time in 2003, that was cool, right? Those people were out saving the world and helping poor people buy homes for the first time and all that kind of stuff. So anyway, I went and interned for this company for a summer. And at the end of the summer, the guy came to me and he's like, "Hey, we don't need another loan officer. We got dozens of loan officers, but my partner and I, we do some hard money lending on the side of our main, mortgage lending company. Are you interested in working with us on hard money loans? We need someone to act as basically a loan officer or an account executive for our hard money lending business." And I was like, "Well, I don't know anything about hard money lending, but sure, right? I'm 22 years old and, I'm happy to learn. Sounds fun, sounds interesting. And I don't know what else to do with my life." So anyway, that's how I got into real estate from the hard money side. And then, of course, it's the mid-aughts. So everybody's making money hand over fist in real estate. It's a big party in the real estate industry, right? So I'm like, I can do this too. I can make money on real estate too. All these guys are doing it. I can do it. So I went out and I plowed just a ton of money into, well, a ton for me at the time as a 20-something, into buying all these rental properties. And I had no idea what I was doing. And I just made every possible mistake you could make. I had that hubris of youth where, I didn't get a mentor and I didn't get a coach and I didn't get a senior partner, just thought I could figure it all out on my own. And, the universe has a way of correcting you when you do that. And of course, that's what happened in 2008.
And then when that correction came, what did the aftermath look like?
Well, it was ugly. It was ugly for me, actually. I got hit with a double whammy. So on the one side, on my investments side, that looked like negative cash flow and upside down properties and all that stuff because I had over leveraged like so many people did in that era. And then I lost my day job too, right? So, I got hit from both sides of that, both on the investment side and on my active work side, because no one's doing hard money loans anymore, right? No one's flipping houses anymore all of a sudden in 2008. So that was a hard pill to swallow. But I went out, I got a job for it was an online company that was servicing mom and pop landlords and mom and pop investors. And the only reason I got that job was because I myself was I guess a pop landlord and real estate investor. So, that's how the universe works, right? Door closes, window opens, and it ends up being okay when it's all said and done. So I got to learn a whole nother side of the business, servicing investors, digital marketing, all that kind of stuff. And in 2016, a former colleague from that company, she and I went out and we launched our own online business serving real estate investors, as a blog, as a podcast, selling online courses, offering tools and all those sorts of, largely free, but also, some premium kind of stuff for real estate investors. So that's how Spark Rental was born. And that's how I'm sitting here on your show today.
So Brian, did the thought ever cross your mind, maybe I shouldn't be in real estate? You must like pain because you lose your job, your portfolio gets up in flames, you thought you were the stuff, and now you're not the stuff. I mean, honestly, why didn't you quit? What was it about real estate that you liked? Because you must have liked something about it.
Well, so there's a couple answers to that question. One, so this is before the fire movement, right? The mid aughts. It's before that term got coined. But I had that same idea when I was like, oh, if you own enough rental properties, if you have enough rental income, then you could quit, right? You could quit your job, you could retire. I didn't know the term financial independence at that time, but that's basically what it was. So I liked that aspect of it. And that always appealed to me. The tangibility of real estate always appealed to me. And to give you a more raw answer, I was stuck with some of those properties, so I couldn't get away from them, right? Like they were upside down. So I couldn't sell. I couldn't get out of real estate even if I wanted to get out of it. But I also, it helped that I got a job that was still in the industry, right? And I came to look at some of those really expensive lessons and mistakes that I made earlier. I came to look at them as tuition, right? Like a lot of people would have just gotten out of real estate and said, "Screw it, it's not for me. I lost all this money. I'm never looking back at it. I just want to get out." And if you do that, then those truly do become losses, right? But if you learn from those expensive mistakes and apply what you learned in either future investments or your future work within that industry, then it just becomes tuition, right? It becomes the cost of education, and that's how I chose to look at it.
Ladies and gentlemen, the Confessions of a Real Estate Investor, brought to you by Brian Davis. And
Amen.
that leads me to the next question. I mean, so perfectly. I think we've done this before, me and you. It's very interesting because I heard you and a couple of really big mistakes for people to really highlight. The first one that I wrote down is over leveraging and not understanding the finance right portion of the framework. We have buy right, manage right, and finance right. And everyone is jumping on the bridge debt bandwagon the last 2 years, and now it's coming due. Very similar back in 2008. You can always buy real estate. You can't always exit real estate. So Brian's got these assets that he wants to get rid of. And I think he keeps saying doors, windows open. Well, he got stuck with them, which is a good thing because it made him learn that painful lesson. So over leveraging is one thing. The second thing is your tuition was learned on the street, not in the classroom. That's why we really are big proponents of investing in ourselves, of investing in masterminds, of joining different groups. We've spent hundreds of thousands of dollars, and I have the same horror stories as you. So I could have the Confessions of a Real Estate Investor, brought to you by Gino Barbaro. I'm sure I got a lot more scars than you do. I'm a little bit older than you, but let's go back to that and let's share a couple of other really big mistakes that you wish you would have avoided, or there are opportunities now. You didn't know there were problems back then.
Yeah. So great question. I'll share a couple quick and clear ones. One is learning how to forecast cash flow. Here I am buying all these properties. I mean, I bought like a dozen properties, and it never learned how to forecast cash flow properly. I'm still running around thinking that it's the rent minus the mortgage. And in retrospect, it's really embarrassing to share. But that's what I was doing. That's what I was thinking. In my 20s, when I first got into this industry. And one way that we try to shake people out of that mentality now, when we talk to people who are thinking about getting into direct rental investing and actively buying rental properties, the first thing I try to tell them is the 50% rule, where as a broad rule of thumb, they can expect around half of the rent to go to non-mortgage expenses averaged over time, right? That's not a typical month, but you can't look at what happens in a typical month. You have to look at the long-term average of expenses like vacancy rate, like repairs, like maintenance, and like property management fees. So, that is something that novice investors get wrong all the time. They look at what a typical month looks like, not what the long-term average expenses look like. So, when people first hear us talk about the 50% rule, or anyone else talk about the 50% rule, we certainly didn't make it up. It's a thing in the industry. their first reaction is, well, oh my God, like how am I going to find a property that cash flows well? That's impossible. And then we'll say, yes, exactly. Now you're starting to get it. It's really hard to find properties that actually cash flow well. You can't just walk up to the cash flow tree and pick a property off of it. Like you have to go out and set up direct mail campaigns and find distressed owners and all these other things. I mean, obviously there's a million different ways you can find deals on properties, but they all take work, right? They're not just sitting around on the MLS. So that's one expensive mistake that I made. Another one is, and this is a little bit more controversial, but I think it's something that people need to hear. Lower income rental properties are a niche investment strategy that requires niche skill set. And the cash flow on paper, like even if you did learn how to forecast cash flow properly, averaging out those long-term expenses, there are still a lot of expenses that are invisible on paper that come with lower income, lower end rental properties. And I'll give you a couple examples of those. Again, it's not necessarily, it doesn't fit that PC narrative that a lot of people want to hear, but this is what real life looks like when you're investing in some of these grittier properties. One example is you tend to have higher turnover rates, and as as an income investor with rental properties, turnovers are where most of the expenses and most of the labor come from. On your end, the expenses and the labor when you're a landlord don't come from the typical month, right? Where the tenant pays and you just send off your mortgage payment and you call it a day. They come from the turnover where you have to repaint the units, maybe recarpet the units, and you have to show them and advertise them and blah blah blah. So you tend to have higher turnover rates with lower income properties. That's a problem. You also tend to have the dregs of property managers actually willing to work with those properties. So, property managers get paid as a percentage of the rent, right? Or a monthly fee for filling a unit. But either way, they get paid based on the rent. But these lower income units tend to be more work for them. So they're getting paid half as much to work twice as hard for a lot of these lower end units. Why would they do it? And skilled property managers figure that out really quickly. So they don't work with those properties, right? They just refuse to work with them. So that leaves you with really the dregs of the property management industry, the much lower skill, less professional property managers. I was buying properties in a lot of these bad areas in Baltimore City back in the mid-aughts, and that was a problem I ran into again and again and again. It was almost impossible to find a really good, reliable property manager who was super professional and was on top of things for me. Those people just didn't work with these properties. So and then crime is a factor. I've had so many air conditioning condensing units been just ripped apart for the copper inside. And those are, I've had appliances stolen out of properties, breaking and entering and all that stuff. And then there's also the secondary impact of crime, where even if it's not direct damage to your property, you have good tenants who end up moving out of those properties because of the crime in the area, right? So those are those are a couple less expensive lessons I learned the hard way. And last one is active real estate investing. Going out and buying properties is not only is it not your only option, it is the harder option for investing in real estate. Passive real estate investing is a lot easier at every level. It's easier to learn. It's easier to execute. So that is something that I wish I had known back in my 20s, that you don't have to go out and become a landlord to invest in real estate. You can invest passively. And of course, in today's world, it's a lot easier to invest passively than it was then, but you still could do it then too. I just didn't know that. So, all right, I went on a little long there, but those are some of the lessons.
Not at all. I mean, and I'm going to follow back up on everything that you've mentioned, because on your mistakes, the first one is what Brian is actually saying: don't fall in love with high cap rates. Just because you see a 15 cap in Rochester, New York, or in Baltimore, doesn't mean it's a good deal in and of itself. Higher cap rates tend to be more risky. That's the reality. The other thing is you're talking about asset management. This is what the manage right portion of the framework is. When Brian started out and when Gino started out, we thought we were just buying some deals, we're going to make some money, but there's actually an asset that you need to manage. You're managing the future cash flows of the property. Understand what an income statement and a balance sheet is and a statement of cash flows. If you don't know those three words, hit the e-brake, go find out, and then go find somebody who can teach you about it. Because what you're basically doing is you're becoming an entrepreneur in real estate and you're buying a business. If you don't understand that, you will end up like Brian and like myself making huge mistakes. I think the last point, I can make so many points on this, but the last one, which is very important, that we also learned the hard way. Find out what the median income is of the area you're buying. In certain markets, median incomes of $50,000 plus may be okay for the resident base because I've bought in difficult and marginal areas. The problem with those areas is there's no appreciation, like Brian said. So you're buying an asset today for $50,000. 10 years from now, it's probably going to be worth $50,000. And guess what? It's 10 years older. And the maintenance and all of that goes into it. So understand median income and crimes. And I'm not saying not to invest in those areas, but go in with eyes wide open. It's going to be much more challenging. It's going to take a lot more effort. I have that ROE, return on effort. The cap rates may be a lot higher, but who cares what cap rate you're buying it at if you can't collect the rent? That's the reality. The reality is you need to collect the rents to have any kind of cap rate, correct?
Yeah, I mean, it's an investing niche, and you really need to treat it like that. There's niche knowledge and skill required to invest well and
Mm-hmm.
consistently in those areas. And if you're not prepared to go out and get that niche knowledge beyond the broader knowledge that you need as a real estate investor, then leave it to other niche investors who do have that knowledge and who are going to beat you out every time if you aren't going in with the same knowledge.
Mm-hmm. Brian, how did you start writing about personal finance? What was the passion about starting a blog and writing about the personal finance side of life?
Yeah. So when I got hired by that e-commerce company back in 2008, one of the things that I was asked to do was to write for their blog. I always loved writing, throughout school and, even after college, I went and I took a bunch of film classes and was particularly interested in the writing side of that. So I've always had an affinity for writing. I wrote, many, many hundreds of articles for this other company that I was working for and honed that skill some more. And then when we launched Spark Rental, the first thing we did, of course, was launch a blog and start trying to get organic traffic through SEO. And when you start a business, as you know, it's it's hard, right? You're not making any money at first, but you're putting in a ton of effort and putting in a bunch of money. So one of the ways that my partner and I extended our runway for Spark Rental was to pick up some work on the side, to keep earning money actively in addition to trying to get a startup business off the ground. So my partner went the route of, she was a realtor already, so she was just continued doing some real estate agent work on the side, and the route that I took was writing as a personal finance and investing blogger, for other people's blogs. Uh, so that's ran the gamut from basic personal finance stuff like budgeting to investing both in paper assets like stocks and bonds and also in real estate and other hard assets. And I still actually do a little bit of freelance writing to this day. I enjoy it. It helps my wife sleep at night. So it's still something that I do. Even though Spark Rental is 8 years old at this point. So, yeah, that's how I got into the writing side of it.
I always like to say people with financial intelligence can change the world for the better. And by you writing that personal finance blog, you are changing people's lives. When you're writing about personal finance, what are some of the key stories that you've written over the years that you're like, that's something that I will never forget that I wrote that's really helped somebody out?
Well, it's funny, but literally 15 minutes ago, I was on the phone with somebody who this guy emailed me out of the blue and he said, "Hey, my son emailed me an article that you wrote for Bigger Pockets." And and he runs a fund of funds and he was asking if I would come on as like a fund advisor for him basically. And so I was like, well, that's not something I've done much of before, but I'm happy to talk to you. And at the very end of the call, I was like, by the way, which article was it that your son sent you? And he said, oh, it's this article that you wrote about about an academic study comparing returns on stocks versus bonds versus real estate over 145 years in 16 different advanced economies. And I was like, man, I wrote that article like 5 years ago. Like, I had no idea anyone was still reading it, but apparently it's still getting read and still getting traction. So anyway, that was a particularly salient example because we just talked about it. But
what were the findings on that? Let me ask you, because for me, when you write an article like that, there's a lot of expertise that has to go into it. There's a lot of you're doing a lot of research for that, and we all have our own paradigms, our own biases. And I'm going to say right off the top, I'm the real estate guy. I would never right now invest in those other asset classes. I have too many tax benefits. I have the principal pay down. I have the cash flow model. I have the basic human need. I can give you 30 of my own reasons why I love real estate over stocks and bonds. What did you actually find in that article? What was the empirical evidence that you came up with that said one asset was much better than the other?
Yeah. So in this particular case, I was just summarizing and reporting on an academic study that was done. I was just trying to make it accessible for the layperson. But
for someone like Gino, by the way, yes. Okay, good. I got it.
Well, I mean, you know a thing or two about real estate. Let's be honest. But so this particular study, it was a combined study between a U.S. university, a German university, and the German central bank, actually. So they looked at 16 advanced economies over almost 150 years, and they were comparing how different asset classes did. And what the short version of what they found is that stocks and real estate perform, and by real estate, what they mean income properties, the residential rental properties, basically, is what they were looking at for this. They found that they achieved a similar annualized return. They were both around 7%. Real estate rental properties actually beat out stocks by a slim margin. They were both around 7% per year. And that's combining income and appreciation on both sides, right? So dividends for stocks, rental income for properties. And then it went way down from there for bonds. Bonds did not perform nearly as well, as we could all probably guess. But what was interesting about the study was not so much that the returns were very similar, but that the volatility for real estate was half as much as it was for stocks. And volatility is one of the main measures of risk, right? So that was an interesting way of looking at it, that you're not only earning slightly higher returns on real estate, but you're getting those slightly higher, or let's call them the same returns, with half of the risk that you have with stocks. Now, that being said, real estate comes with some other inconveniences, right? Like the lack of liquidity and the high cost to enter and to exit. So it's not all rainbows and butterflies, of course, but that was the nutshell of what that study found.
I love that. And the fact that they probably should take taxes into the mix when you have depreciation. And when you take that one in, I can almost guarantee that real estate will beat stocks. But to your point, you made a great point, because real estate is active. You need to be in the business of real estate, and the liquidity can work with you and work against you, because Brian tried to exit his deals years ago and he couldn't. It wasn't liquid. So it made him stay in there, but that's a positive, because if he wasn't in there, he wouldn't be here and he wouldn't create a Spark Rental. Let's take a quick time out to hear from our sponsors.
Now, we have had a great run in multifamily, going from 0 units to over 250 million in assets. That's over 2,000 apartment deals that we've been able to purchase through our framework: buy right, manage right, and finance right.
Now, Jake and I, we created the Jake and Gino community back in 2015. We launched our first book, Build Our Profits. And since then, our students have closed over 60,000 units. That's over $4 billion in assets they've been able to close over the last 6 years.
And that's why this community has been so successful. We call it results-based education, and we pour back into the community everything that we've learned on our journey from 0 to 2,000 units, and all our systems and scale that we use on our very own property management and investing companies.
Jake, I love that. It's not just education, it's implementation. So what I want you to do, click on that link down below, apply to work with our team, see how we can help you on your journey in multifamily.
We are back. So talk to me about Spark Rental. What made you come up with the idea, the spark that created Spark Rental?
Well, it's funny when you talk to entrepreneurs about if they've been around long enough, most of them will tell you that what their original vision for their company and what they thought their business was is actually not necessarily what the market told them their business was, or at least what their business should
Yes,
be.
I agree.
So, my partner and I, when we first launched Spark Rental, our vision was a property management platform for mom and pop landlords, basically like a one-stop shop, very easy to use, simple but comprehensive software platform for managing rental properties. If you're a landlord with an unrelated full-time job and you own a few units on the side, at the time there wasn't really a good software platform for those kinds of investors, the mom and pop people. Um, that's not, we do still offer that today, but that is not the direction that our business ended up taking, at least as our primary business. So we started, and there's a whole bad story about how our software developer ran off with our money, and there's all kinds of bad things that happened along the way. But we ended up building out more of an education business along the way because it took us so long to actually get the software launched and where we wanted it. So we ended up focusing more on education, starting with a blog and later a podcast, and we launched online courses, some free courses and some premium courses. And along the way, our course students and our broader audience members, they kept asking us like, hey, I really want to invest in real estate. I'm not quite ready to go out and buy my first rental property yet. Can I just go in on some investments with you guys? Like, can I just invest money towards whatever your next investment is? And we kept saying no, right? Like, we kept saying no, like the first 100 and some times that we heard that question. I was living overseas at the time. I was in Abu Dhabi, and my partner was no longer actively investing in real estate either. And, we were feeling a little out of alignment about that, we're teaching real estate investing, but we're not actually investing in real estate ourselves anymore. So at a certain point, my partner and I looked at each other and we were like, well, maybe the market's trying to tell us something here. Like, maybe we should actually take this question seriously instead of just saying no without thinking about it. What would it take to actually say yes to this? So we partnered with a guy, a boots on the ground investor. He was up in Michigan, and we did a couple single family investment property deals with him that we opened up to some of our course students. And they went fine. We earned perfectly fine returns, but they were just way too much work. And there were too many decisions that had to be made and too many meetings. And, when things went wrong, everyone's like wringing their hands and hemming and hawing. And so we were like, this isn't working. This is not working for us. But, our audience members, they loved it. Like they loved the hands-on aspect of this, of like the learn while you earn kind of model, and investing small amounts in a larger deal. So, and it was around this time that I had started investing passively in syndications myself, just personally. So I went to my partner Denny and said, like, hey, this is too much work doing this with single family properties, but what if we did this with a passive real estate syndication investment? So she shrugged. She's like, well, I'm not that familiar with them, but we can learn, right? Like we can do a pilot deal and see how it goes. So we did, and our students loved it, and so we wanted to do more of these. And then we said, well, hey, could we open this up to the general public and not just our course students? Because at the time it was just like a benefit basically to our, for our course students. So we were like, well, is that even legal? Can we do that? So we talked to an attorney, and he's like, yeah, you can do that. There's precedent for that as an investment club. So we launched a passive real estate investing club. We call it our co-investing club. And every month we get together, we vet a different deal, and any members who want to can participate in that deal. No one has to. Which gets to the root of the drawbacks to passive real estate investments: the high minimum investment, 50 grand, 100 grand, deal flow, and finding syndicators who allow non-accredited investors. So any of our members who want to invest in a deal can do so with 5 grand a person instead of the typical 50 grand, 100 grand. There's deal flow every month. I invest my personal money in every one of these deals. So there's very much an alignment of interest in these, and it's a very democratic investment club. And it's fun. It's a lot of fun. We get to
Mhm.
vet these together every single month.
Brian, I need to share the story of when I started the restaurant over 20 something years ago. And I think it's very similar to your story. And this is really an appropriate message for anyone wanting to start a business or becoming an entrepreneur. I started the restaurant to provide for my family. I didn't start it to provide value for the customer or to provide value for the marketplace. And that is probably one of the biggest mistakes that I made. And I had that epiphany. And it's unfortunate because we had an amazing little restaurant. And I was always thinking about scaling and getting bigger when really in reality, all I should have done was thinking about providing value for the person coming home late at night to take food home, or for that bar mitzvah, or for the confirmation or the communion or the graduation party. I wasn't focused on that earlier on. So if you're even focused on getting into business and buying multifamily or buying apartments, your focus should be not on how much I'm going to make. The singular focus should be on how am I going to provide value for the residents? How am I going to help my employees out with the mission? And if and when I do have investors, they are my boss. How do I provide value for them? And if all of that works really well, and hopefully it does, then guess what? You get paid last. You're the last person. And I like the way your company started in a certain way, and then it ended up pivoting, and it ended up finding where the true value is and what the marketplace wants. It's not what Gino or what Brian want. The marketplace doesn't really care what we want. I mean, we could, but we're not going to get paid from it very long. And if there's no margin, then there's no mission. Priest told me that. There's no margin. They're not going to have any kind of mission. And it's the same thing in business as it is in any other venture. You need to be able to be profitable, and the marketplace will tell you whether you're profitable or not. And then you start hearing clues. You have over 100 people telling you, "Hey, let's get into this." How do you vet sponsors? Let's get into the syndication aspect of it. How are you looking at deals right now? Because you're coming from a place of not knowing anything, having a few single families. Now all of a sudden, the whole syndication world is opened up to you. What are you looking for in these syndicated deals?
Yeah. So there's I can't remember the guy who wrote the book, and I can't even claim to have read it, but it's a wonderful line from the book The Road Less Stupid, where he says, novice real estate investors ask, how much can I make on a given deal? Seasoned real estate investors ask, how much can I lose on this, right? Ultimately being that the focus needs to be on risk first. So that's the lens through which we look at every single deal that comes across our desk. And there are a lot of different categories of risk in this particular space. The first and most important probably being sponsor risk, right? So, you only want to work with experienced, reputable, and very sponsors with high integrity, shall we say. People, like you said, who are putting their investors first and not themselves. So that's the first element of risk is just vetting sponsors. And you could have an hour-long conversation about just that. But that really needs to come first, is analyzing sponsor risk, working with really good sponsors who have a lot of integrity. A good sponsor can rescue a failing deal. A bad sponsor can ruin a perfectly good deal. So sponsor risk has to come first.
How do you find sponsors, Brian? I'm sorry, before you go, because it's important. Like, how are you vetting Are you going online, just Googling people's names? Are you in other real estate groups? How are they coming to you?
Yeah, so we aim to find sponsors through word of mouth from other sponsors. So whenever we meet with a sponsor, the last question that we always ask them is, hey, who else in this industry do you know, like, and trust? Maybe even sponsors who you've invested with yourself as an LP, right? So that's our preferred method for finding sponsors. Also, some of our club members, the club has grown by this point where our club members are now forwarding sponsors' names to us, say, hey, like, this is someone who I've invested with, who I really like, or someone who my cousin has invested with and he really likes, or whatever. So our club members are now passing along sponsors' names to us as well. We do sometimes reach out to sponsors who we hear on podcasts, or find through some other means like that. But our preferred method is referral from other sponsors who are right in this space working alongside them.
That's awesome. And what else are you looking for in a deal? We got the sponsors, vetting sponsors. What else are you looking for?
Yeah, so debt risk is a big one, of course. we like to see longer term debt that gives you, a longer time for the market to change, right? As opposed to the really short, like 2 or 3 year bridge loans. Fixed interest, obviously better than variable interest. And I'll give you a really quick example. There was a deal that we turned down last year. I think it was a 2 year bridge loan that they were planning on financing with us with. And we were like, I don't know what interest rates or cap rates are going to look like in 2 years from now. They might look just as ugly as they do right now, right? Like, or even worse potentially. And then we ended up doing a different deal where the sponsor was assuming a fixed interest loan at 5.1% interest with another 9 years remaining on it. And the calculus then becomes like, well, I don't know what will happen in the next 2 years. It may not be a good market to refinance or sell within 2 years, but within the next 9 years, there will almost certainly be a good market for selling, right? Like there will be a good time for selling over that long time horizon. So that's a much lower risk way to invest, right? So looking at debt and how they are approaching that, that's really big. Are they buying an interest rate cap, or they, or are they doing like a swap, or how are they structuring the debt? Is another one. Construction risk is another. If it's a value add deal, who's doing the work, right? Is it in-house construction? Are they partnering with an outside firm? And in either case, how many deals have they done with that construction team? Is it their first deal that they're doing either in-house or with this other team, this other company, or have they done 10 deals already? Either in-house or outsourced. So what's the experience level? What's the trust level with the construction team? You also have property management risk, right? Who's managing it? Same question. Whether it's in-house or whether it's outsourced, how many deals have they done in this market, right? If is it their first time working with this outside property management firm, or is it their own first time doing in-house property management, or have they done 10, 15, 20 deals, either with this firm or in-house, and familiarity with that market. So that's another element of risk. So we look at these and other just buckets of risk, and see how comfortable do we feel with each one of these types of buckets of risk.
This fractional owning, what's the future in it? Because years ago, it was probably a novel idea. It was just taking off ground. Where do you see the future in it?
Well, we see, it's certainly possible that our investment club will become obsolete if this becomes super widespread. We have seen a few more sponsors doing low minimum investment offerings to the public, either through Regulation A or through like Reg CF, the crowdfunding. We still don't see a lot of them doing that. And some of that is because it's so expensive to set up the legal paperwork for those. So I think we will see some more of this opening up on the crowdfunding side. To date, most of the crowdfunding investments in the syndication space are accredited only. We have seen, I can think of one off the top of my head, a sponsor, it's Good Egg Investments, just for anyone who's curious, who has used the crowdfunding regulations to offer a syndication deal for non-accredited investors. So I suspect we'll see a little bit more of that, whether it will become super widespread or whether it will remain kind of prohibitively expensive on the legal side for people to do that. I don't know. So that's one area where this could go. We have seen this happen on the single family side. We've seen that rise up in crowdfunding, where you can go out and buy fractional shares of single family rentals for small amounts. So Arrived was the first to do this. They sell fractional shares for $100 a piece for single family rentals. And they're pretty reputable. I've got a little bit of money invested with them, mostly just so that I can write about it, coming from a place of direct experience. Problem with Arrived is they don't have a secondary market for selling shares. So it's a long-term commitment. There's no liquidity. Arc 7, I like them in that space. I think they're still at $20 a share, so very cheap and accessible for anybody to do. Again, open to non-accredited investors, and they do have a secondary market, which I love. So after a minimum holding period, I think it's a year, you can sell your shares. Lofty does this as well. And they too have a secondary market. The problem with their secondary market is that they pay you out in cryptocurrency as opposed to US dollars. So then you have to jump through the hoops on the back end of, setting up an account with a crypto platform or an exchange and then converting it back to US dollars. Not everyone is comfortable with that. So we have seen a few of these marketplaces arise and like crowdfunding platforms arise for fractional shares in single family rentals. And that's somewhat popular. So we'll see if that continues to grow. But syndications, we certainly hope that these continue to become more accessible to people, including and especially non-accredited investors. And in the meantime, we will continue serving people who want to get into these with small fractional amounts, but who don't want to go out and have to do all the heavy lifting themselves to find deals and vet sponsors and invest the full 50 or 100 grand in these.
I think the bottom line is just to do your due diligence. There's going to be companies that are popping up. There's going to be opportunities. It's like when the internet started, everyone was a doubter. Everyone was a hater. It's just one of those things where it makes sense. You're able to diversify your holdings. If you're in the stock market and you want to put 10 or 50 bucks into a deal, just go and do your due diligence. Make sure your attorney looks over all the paperwork. Make sure, you've got reviews and understand what your goals are. If you're looking to get your money back in the next 6 months, it's probably not a good thing if they don't have a secondary market and there's no liquidity. So understand that. Brian, before we close out the show, where do you see yourself in Spark Rental in the next 3 to 5 years?
Yeah. So, I mean, my partner and I are very passionate about Spark Rental. My partner is a little older. She's in her 60s. And we were just talking this morning about, the sort of longer term trajectory of the business and, how much longer she wants to stay in. And she was like, honestly, I'm so passionate about what we're doing that I don't see myself wanting to exit or leave anytime soon. And that's how I feel. Yeah, I do think that we will, instead of putting 45, 50 hours a week in it like we are now, I think the time will come when we delegate some more of that to employees. But we're in this for the long haul, as evidenced by the fact that these investments that we're making as a club every single month are mostly long-term investments. These are 3 to 7 year investments that we're largely making, and we're going to have to be here to administer these LLCs and these joint investments that we're making. We're in it. We're committed to the long haul, and I don't see myself going anywhere.
That's awesome. Where can the listeners get a hold of you?
Check out sparkrental.com, of course. You'll see our investment club and you'll see our other tools for investors there. We have a bunch of interactive maps, a bunch of calculators, for active investors. You can also reach us on any of the social platforms. We have a couple of really big Facebook groups, by the way. We have one that's around 48,000 real estate investors, more designed for active real estate investors. We have another that's about 8,000 members, designed more for passive real estate investors. So yeah, check us out on Facebook, LinkedIn, Twitter, or X, I guess now we have to call it. And you can email me personally. Email me at brian@sparkrental.com. I mean, like I said, I'm in the trenches here, every day. So you'll reach me personally, not a bot or an assistant.
Awesome. And he's written on Bigger Pockets. He's written on RE Tipster. He's written a lot of other websites as well. So go check him out. But to recap Brian's story, I mean, getting out of college, he was confused. Like most people getting out of college, like, what do adults do? I don't know what they do. Let me get a job in the real estate space. Mortgage-backed securities. I think that's the place I want to be in 2003. Little did he know, in 2008, after having about a dozen rental properties, life came crashing down, and he was left holding the proverbial bag, and he couldn't get out. But he liked the pain. He liked real estate. He said, you know what? I think this is a really cool industry. I'm going to go back, find another job. I'm going to see what I can do with these rental properties. And in 2016, he starts Spark Rental, starts with his partner, and it starts as a different version of what it is today. But it's one of those things where he's passionate about real estate. He was passionate about personal finance. He started writing about it, and he started creating a following. And then all of a sudden, someone comes knocking on his door and says, hey, how about we start investing in other deals? Now, heard it 3 times, 5 times, 10 times. After the 100th time, I mean, it took him a little long. He was a little slow in the uptake, but that's okay. We'll let that pass. He said, I think we got something here. So he put together this passive club, and I think that's going to be the future for a lot of people. Now, I don't want people to look at it as a mutual fund because it's a little bit different than a mutual fund, very similar in the ways that you do it, but you need to vet Brian's company. You need to vet the deals. There's a lot of due diligence that goes on. But if you're looking for a way to invest passively in real estate and to really start diversifying your portfolio of holdings, even within real estate, if you're an active investor and you just want to put some money on the side working passively while you're doing both gigs, why not do both gigs? Go check out Brian at sparkrental.com. Brian, thanks for being on the show today, brother. It was a great show. Enjoy you being on.
Gino, thank you so much for having me. This was a lot of fun.
Take care, Brian. Thank you.